The purpose of this video is to give you some background on financial instruments at amortized cost with reference to debentures specifically as the example thereof. With a debenture, there are two parties involved. You have the party issuing the debenture that is seeking to get finance from that debenture, and then the investor who is giving the money across to the issuer and investing in that debenture. The investor gets interest from this arrangement, so earns a return that is paid to him by the issuer, and the issuer receives the capital up front for whatever financing purpose he may have. At the maturity date of the debenture, then the money is repaid to the issuer, to the investor. So there's a cash flow wise, there's a capital cash flow up front from the investor to the issuer, and at the end that cash flow is reversed, and in the interim there's interest paid by the issuer to the investor. The debenture, as we've said now, has interest associated with it, and that interest is based on the par value of the debenture times by a nominal interest rate. But the debenture doesn't necessarily have to be issued by the issuer at this par rate. He may choose to issue this debenture at a discount or at a premium, and that decision interacts with the interest rate because it affects the whole return on this investment instrument. So coming to the accounting now for this investment instrument, you have in your investor's books an investment. He's invested in these debentures to earn a return, and you have a liability with the issuer as he needs to pay the money back to the investor at the end of the lease term, as well as interest over the period. So those are the performance obligations you're looking at, and it's conceptually a liability in terms of the framework. Now, for your initial recognition for either the investment or the liability, you're looking at fair value. This fair value is based on the future cash flows from this debenture, which are the interest amount and then the redemption capital amount. All of those amounts will be discounted back to a present value, and this is the amount that must be used for your initial recognition. If this amount differs from what was actually paid and received by the issuer and the investor respectively, you need to do a day one adjustment to this fair value, and that's recognized in your profit and loss on the first day of this economic event. Then you may also have transaction costs. These transaction costs may be incurred by the investor and or the issuer, and they are not between these two parties. These parties would probably work both through brokers, and the transaction costs would be paid to them. The transaction costs would be a bank cash flow credit bank by both parties, whatever the amount, it may not be the same, and the debit entry will be capitalized to the investments in the investor's books and debited to the liability in the issuer's books. Again, it's important, it's not between these two parties. Each may have their own brokers paying them their own amounts. The journal entry you see at the bottom of your screen now is your initial journal entry before the transaction cost. So your investment, the debit or the credit through the liability, is at the fair value. Your bank amount would be the cash that is exchanged hands, and if there's a difference between that fair value and the cash that changed hands, you'd have that fair value adjustment on day one. So we've looked at the initial measurement now and the initial recognition and doing the first day fair value. The next thing now that happens is those transaction costs, and to illustrate that, there's a set of 4 T accounts in front of you now. The T accounts in green are the investors' T accounts, and the T accounts in blue are the investees' accounts. The liability side in blue, the asset side in green, in 2 separate books. What's important to note here now is that transaction costs of 100 Rand. If you're looking at the investor in the green, he's got it there at 100 Rand on the debit side because he paid his broker 100 Rand. Where the liability is the issue of your debenture, that's now transaction costs. Sorry, just to correct that, the 100 Rand is the amount that the debenture was initially recognized for before the transaction cost. So that's the 100 Rand on the debit side. And then on your liability side, it's the 100 Rand. The transaction costs are on the debit side in green for the investor, and then you'll see that journal entry is also on the debit side for the person issuing the debentures. So the effect thereof is on the first day of this transaction in your asset account, that initial recognition is increased now by the transaction costs. There you have your debit being added to your initial debit. The difference, though, with the liability side is your initial recognition of this liability is on the credit side. You have incurred transaction costs paid to your broker. That's on the debit. So in this case, it decreases your initial recognition amount. So that deals now with your initial recognition of these instruments, either in the investor's books or the person that has been issuing the debentures, the issuer's books. So you'll have your amount there now at the present value of the future cash flows, adjusted with your transaction costs if necessary. Now your debenture may be settled in future at an amount which is the same as the par value initially, or it's a premium, or it's a discount. So there will need to be a movement in this account. And we will come to that now. But if, for example, look at the first green tier account, the amount recognized initially was R100 if there's no transaction costs, but it matures at a discount for R90. So over the period of this debenture, we will need to decrease this account from the R100 down to the R90. What happens, though, after initial recognition is over the period now there's going to be interest recognized. Now, your interest on your debenture, as we mentioned, is based on the nominal value of the debenture times the nominal interest rate. So if it's a 10% debenture issued at a par value of R100, your interest for that year will be R10, the 10% times the R100. But in your T account, that might not be the amount that is initially recognized, because we in accounting recognize it at fair value. So for our purposes for the income statement, we want to use what we recognized as the value of the asset or the liability to base our interest calculation on for the income statement side of things, the profit and loss side. So for that, we take the balance of our account times by an effective interest rate, and that will tell us then what the interest needs to be for each reporting period. That effective interest rate, to work that out, what you need to do is you need to have a look at what was your debenture initially recognized at. That's your present value, taking into account transaction costs. Then you put in as your future value the amount that it matures for. And then you take your cash flow interest over the period based on the nominal value times the nominal rate, the cash that will be exchanging hands. And then you calculate an interest rate, and that interest rate will tell you what your effective interest rate is for accounting purposes to calculate the interest that you're going to be showing in profit and loss. So looking now at your journal entry to account for this interest, the debit entry there that we referred to for bank, that's your actual cash flow. That's the nominal value of your debenture, perhaps R100 debenture at 10%, so that'll be R10. The finance income part that goes to profit and loss, that will be based on the balance in your T account, that present value adjusted for transaction costs times by the effective interest rate. And then if you have a difference between those two, between your effective interest rates and profit and loss, and between your cash flow and bank, that amount is taken through to the investment account. And that represents these adjustments to get our opening balance eventually down to what it's going to be settled for at the end of this debenture. So to summarize what we've done so far, we did our initial recognition where you have your cash flow. You then have to recognize it at a present value of all the cash flows expected over the lease or over the debenture term. You have that amount present valued. You have capitalized your transaction costs if there are any. You have brought your interest into account over the period of the debenture. And then finally, this debenture will be settled and it will mature. And the journal entries now at the bottom of your screen illustrate what will happen with the settling of that debenture at the end of the term. And in your general ledger T account, it's that credit entry, or for a liability, that debit entry.